Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
All right, folks, welcome back. Today we're diving deep into a topic that's probably on a lot of your minds, especially if you're running a business in the, lower middle market. We're talking about mergers and acquisitions, M&A, as we head towards 2025.
Yeah, the big M&A.
Exactly. And our roadmap for this deep dive is a fantastic report from RKCA.
Oh, yeah, RKCA.
They're the folks who really know the middle market inside and out. We'll be unpacking some pretty fascinating stuff, like why private equity firms are sitting on a mountain of cash right now, what they're actually looking for in a business these days, and why, the whole process of selling is just as important as the price tag itself.
That's right.
Right. I mean, it's not just about the number. There's so much more to it.
It's like, have you ever sold a car, like a used car?
Yeah.
You can just put it out there and someone's going to give you whatever they're going to give you. Or you can really, detail it, think about it, make sure it's running right.
Right. You got to stage it.
Stage it.
You look all pretty. Exactly.
Yeah, that's what we're talking about.
It's kind of like that.
Exactly.
Yeah. So let's jump right in. This RKCA report highlights this almost unbelievable figure, expert speaker.
Yeah.
Private equity firms have like $2 trillion just sitting there ready to invest.
Yeah.
It's an insane amount of money.
It's dry powder is what they call it.
Yeah, dry powder.
It's just sitting there.
$2 trillion. I mean, I can barely even fathom a number that big. But what does all that dry powder actually mean for, the folks like our listeners, the people running lower middle market businesses? Does it mean like a free-for-all, everyone gets bought out?
Well, not exactly right.
Yeah.
I mean, while all that cash definitely signals strong buyer demand out there, the report, it emphasizes that private equity is becoming much more selective these days.
Picky.
Picky. They're not just buying any business that comes along. No. They're looking for quality, and they're willing to pay a premium for it.
So it's less about just selling and more about building a business that really shines, right? One that really stands out from the crowd.
Yeah, exactly. Think of it like this, right? Imagine you're at a farmer's market.
Okay.
Right? And there's all this beautiful produce, but you're not just going to buy the first apple you see.
No. Yeah.
You're going to look for the one that's, the perfect size, the perfect color, no bruises.
Right. The one that's like calling your name.
Exactly. And that's kind of what private equity is doing right now. They're looking for those perfect apples.
So what does RKCA say makes a company like that, a high quality company in this environment? What are they looking for?
Well, they lay out 4 key characteristics. And, this is really important for anyone, thinking about potentially selling their business down the road.
Mm-hmm.
First up, you absolutely need strong financial controls.
Okay, so that makes sense.
Right. But it's not just about keeping your books in order. It's about having a really clear understanding of your profitability drivers.
So it's like knowing exactly which ingredients make your secret sauce so delicious.
Exactly. It's not just throwing things in a pot and hoping for the best.
Yeah, no more like kitchen sink stew, right?
Yeah.
We need to know what makes that flavor pop.
Yeah, you got to know your numbers. And you got to be able to show a potential buyer how you can, impact your bottom line, pull those levers.
I like that, pull the levers. Okay, so strong financials, check. What's the second characteristic RKCA highlights?
All right, number 2 is having well-documented processes and systems.
Okay, so we're talking about like having a manual, having things written down.
Yeah, this is crucial, especially in the lower middle market, where businesses often rely so heavily on the owner's knowledge and expertise. To be attractive to a buyer, everything needs to be, codified,
right,
repeatable, so the business can run smoothly, even if the founder isn't there.
Imagine if you suddenly had to take a 6-month vacation. Could your team keep everything running without you?
There you go. That's it.
That's the test, right?
That's the test.
Yeah.
Can someone else step in and run the show without you having to, be there every step of the way?
Makes sense. All right, what about number 3? What's the next characteristic of a high-quality company?
Number 3 is having a strong management team. And I mean a team that goes beyond just the owner.
Okay, so we're talking about building a bench, not just relying on one-star player.
Exactly. You need a team that can step up, make decisions, and, keep things moving forward. This shows a potential hire that the business isn't a one-person show.
It's like if that star player gets injured, the whole game doesn't fall apart.
Right. You got to have people who can step in and hit a home run when you need it.
Love the analogy. All right, so we've got financials, processes, management. What's the 4th characteristic that RKCA calls out? What's that final piece of the puzzle?
Okay, and this one is particularly relevant given all the economic, ups and downs we've seen over the past few years. Number 4 is a proven ability to weather storms. Investors want to see that your business can adapt, thrive, even when things get tough.
Right, so it's not just about performing well when times are good. It's about showing you can handle the heat when things get a little spicy.
Exactly. Think about how you navigated, the craziness of 2023 and 2024. That track record of resilience, that's incredibly valuable to buyers.
It's like proving you can still cook up an amazing meal even if the oven breaks down.
There you go.
You got to be resourceful.
You got to be resourceful.
You MacGyver your way through it.
Exactly. That's what buyers are looking for.
All right, so we've got our 4 key characteristics of a high-quality company. Strong financials, documented processes, a strong management team, and that all-important ability to weather the storms.
That's right.
So far, so good.
Oh, so far, so good.
But building a great business is just one part of the equation.
Yeah.
We also need to understand the process of actually selling that business. Right. And that's what we're going to dive into next.
Let's do it. I'm ready.
All right, stay tuned, folks. We'll be right back after a quick break.
Okay, so we've talked about what makes a business attractive to buyers in this market, what they're really looking for. But let's shift gears a little bit and look at the actual process of selling a business.
Yeah.
Does RKCA offer any guidance on how to approach that, especially for lower middle market companies?
They do. And this is where their expertise really shines. They break down kind of the different scenarios, the different ways this can play out. And for lower middle market business owners, understanding this is crucial.
Okay, so let's hear it. What are the different, paths this whole selling thing could take?
Right. So scenario number 1 is what they call the inbound offer.
Inbound offer.
That's when a buyer, maybe a private equity firm or even a competitor, they just come knocking on your door.
They just show up.
Out of the blue with an offer.
Wow. Okay.
Yeah, it can be tempting, right? Especially if the number sounds good. But RKCA warns that, this often leaves money on the table. Really? Why is that? I mean, it sounds like a pretty sweet deal if they just, come to you ready to buy.
Well, the problem is you're caught off guard. You haven't prepared.
Oh, what's
You
that?
haven't had time to really assess your company's worth or to strategically position yourself for the best possible outcome.
So it's not just about the price they offer. It's about having the time to, make a smart decision.
Exactly. It's like selling your house without, getting an appraisal or talking to a real estate agent.
Oh, okay. I see. So you got to be prepared. All right. What's the second scenario RKCA outlines?
All right. Scenario number 2 is what they call a reactive process.
Reactive process.
This is when something forces a sale, right? Maybe a health issue, a partner wants to exit, or maybe there's some major disruption in your industry.
Oh, okay. So it's like a fire sale almost.
Kind of is.
Yeah.
It puts the seller in a tough spot, Because they're under pressure, they don't have the luxury of time or planning.
Right. It's less about maximizing value and more about just getting out.
Yeah.
Not ideal.
Not ideal.
Okay, so we've got inbound offers and reactive processes. What's the third scenario?
All right, scenario number 3, and this is what RKCA sees as the gold standard, is the proactive process.
Proactive process.
This means planning ahead, even if you're not thinking about selling immediately,
Oh,
and working with advisors, like investment bankers, to develop a solid strategy.
so it's like you're training for a marathon, not just suddenly deciding to run one with no preparation.
Exactly. You're getting ready. You're building your endurance.
Yeah.
You're making sure you can go the distance.
Okay, so I get the proactive part, but why go through all that if you're not planning to sell, right away?
That's a great question. You see, the beauty of this approach is that it strengthens your business. no matter what your timeline is.
Oh, okay.
By focusing on those 4 quality characteristics we talked about, remember?
Yeah.
You're essentially making your company more attractive to buyers down the road.
So even if you're not selling today, you're setting yourself up for success in the future.
Exactly. You're building a better business, period.
Okay, I'm starting to get the picture. But besides, prepping the business itself, what else is important when you're navigating this M&A landscape? What else should we be thinking about?
Well, the financial side of things is crucial,
Okay.
especially the lending landscape.
Oh, right. Yeah, things have been a bit shaky lately.
It's been a bit of a roller coaster.
Yeah.
RKCA points out that lenders are being more cautious these days. And, the rise of private credit, that's increased the cost of capital.
So it's more expensive to borrow money now.
Yeah, and that can be a challenge, especially for lower middle market businesses,
I see.
especially those who are looking to acquire other companies as part of their, growth strategy.
Wait, are you talking about that buy, build, sell strategy you mentioned earlier? Can you break that down for me and for our listeners?
Absolutely. This is becoming a really popular strategy, especially for those who have access to capital. Basically, it involves acquiring a platform company. Which is like your foundation, right?
Yeah.
And then making strategic acquisitions of smaller businesses, what we call add-on acquisition.
Add-on
To
acquisition.
expand your market share or your capabilities,
So it's like you buy a house.
Yeah.
And then you add a garage and then you build a deck.
Yeah, you're making it bigger, better.
You're making it your own.
Exactly. And the goal is to create a larger, more valuable entity that you can eventually sell for a profit.
I like it. So it's like you're building a bigger, stronger castle that's harder for smaller competitors to attack.
That's a great analogy. And for lower middle market businesses, this buy, build, sell strategy can be a really powerful way to compete with the big guys.
Right, to play in the big leagues.
Exactly.
This is all incredibly insightful. We've covered a lot of ground, from what makes a company attractive to the different ways a sale can unfold, and now this whole financial strategy.
Yeah, it's a lot to digest.
It is. But RKCA's report also hinted at something else that's changing, and that's deal structures themselves. What's the deal with that? What are we seeing there?
That's where things get really interesting.
Okay, I'm ready. Let's hear it.
Yeah.
Yeah, deal structures, it sounds kind of technical, but I'm sure it's important.
It is. It is. And what's fascinating is how creative deal makers are getting, especially when we're talking about the lower middle market.
Oh, okay.
They're realizing that not every business is going to be, that perfect acquisition target.
Right.
Remember those 4 quality characteristics we talked about?
Yeah, the strong financials, the processes, management team, and being able to handle the tough times.
Exactly. Well, not every business is, firing on all cylinders in every single area.
That makes sense. So what happens if a business is strong in some areas but maybe needs a little work in others? Does that mean they're out of the running for a good deal?
Not at all. And that's where these creative deal structures come in. It's not always a clean break anymore,
Yeah.
Here's the money.
Yeah.
Goodbye.
Okay, I'm intrigued. Give me some examples. What are some of these more flexible deal structures you're talking about?
Okay, so one common approach is for the seller to actually keep a minority ownership stake.
Oh, interesting.
Yeah, so they're still involved, even after selling a majority of the business.
So it's not like they just walk away completely.
No, they still have skin in the game.
Right.
They can participate in the future growth and upside potential.
So it's more like a partnership than a total takeover.
Exactly. It's a way to share the risk and the reward.
I like that. Okay, what else? What are some other creative structures we're seeing?
Another approach is to use what we call earnouts.
Burnouts.
This means that a portion of the sale price is actually contingent on the business achieving certain milestones after the acquisition.
Oh, so it's like hitting targets.
Yeah, like if the company reaches a certain revenue goal or profitability level, then the seller gets an extra payout.
I see. So it's an incentive for the seller to keep things moving in the right direction.
Exactly. It's a win-win for both sides. The buyer gets some assurance that the seller is committed to the business's success. Yeah. And the seller has the opportunity to, earn more if things go well.
It's like they still have a stake in the game even after they've technically sold the company.
Yeah, exactly. It aligns everyone's interests.
This is really interesting stuff, expert speaker. It's painting a much more nuanced picture of this whole M&A landscape than I think a lot of people realize.
It's definitely not a one-size-fits-all situation.
No, not at all. And this is great news for lower middle market business owners, right?
Yeah.
It means there's more flexibility, more options.
Absolutely. You can find a deal structure that really works for you, for your goals, for your circumstances.
Whether you're looking to, completely exit, or maybe you want to stay involved and keep growing the company with a new partner.
There are options out there.
That's fantastic. This has been an incredible deep dive. I really appreciate all your insights today, expert speaker.
My pleasure. It's been fun.
We've covered so much ground, from those big market trends to the nitty-gritty details of how these deals actually come together. But if our listener is walking away with just one key takeaway, what would you say it is? What's the most important thing they should remember?
If I had to sum it all up in one sentence, it would be this. Knowledge is power. The more you understand about this M&A world, the better prepared you'll be, whether you're selling next year or just building a stronger business.
I love that. Knowledge is power. So, listeners, I leave you with this. If someone offered you an amazing price for your business today, would you be ready? Think about that. What's one thing you could do in the next month to get closer to that level of readiness? Maybe it's digging into those financials. Maybe it's documenting some key processes. Whatever it is, take that step. And in the meantime, check out RKCA's report. We'll have a link in the show notes. And as always, keep diving deep, keep learning.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.